India's manufacturing sector has recorded its weakest growth in nearly 4 years. The HSBC India Manufacturing PMI fell to 53.9 in March, down from 56.9 in February. This is the lowest level since June 2022. The PMI remains above 50, signaling expansion, but it has slipped below the long-term average of 54.2. This means the sector is still growing, but at a much slower pace. What is dragging manufacturing down? The slowdown is being driven by multiple factors. Companies reported weaker demand, intense competition, and rising uncertainty. One of the main concerns is the ongoing conflict in West Asia, which is disrupting global trade flows. The impact is visible in core indicators. Both new orders and output grew at their slowest pace since mid-2022. Input costs have risen at their steepest rate. March saw the fastest increase in input prices since August 2022 and a 43-month high in cost inflation. Aluminium, chemicals, fuel, rubber, steel, jute, and leather all have become more expensive. Despite this, companies are not fully passing on costs to customers. Output prices rose at the slowest pace in 2 years as firms sought to remain competitive. There's one bright spot: exports. Export orders grew at the fastest pace since September 2025. Demand picked up from markets such as Australia, Brazil, Canada, China, Europe, Japan, West Asia, Turkey, and Vietnam. This external demand is helping offset weak domestic momentum. Employment trends remain positive. Manufacturers increased hiring at the fastest pace in 7 months. This helped reduce pending work. For the first time in nearly 18 months, backlogs declined. Also, firms continued to build inventories to avoid supply disruptions, though the pace of stockpiling slowed to a 40-month low. The PMI survey is based on responses from around 400 manufacturers and tracks changes month on month. Despite the slowdown, India's broader growth outlook remains stable. According to official data, manufacturing grew 12.7% in FY24 and 9.3% in FY25. It is projected to grow 11.5% in the current financial year. The government estimates overall real GDP growth at 7.6% for FY26, which requires 7.3% growth in the March quarter. The PMI data is broadly consistent with that outlook, but the March dip signals that headwinds are building. This means that India's manufacturing sector is still expanding but losing steam. Global disruptions, especially the conflict in West Asia, are now feeding into the domestic industry, and rising costs are squeezing margins. For now, exports and hiring are cushioning the impact, but if demand remains weak, the slowdown could deepen in the coming months. Follow for more such stories.